this pilot episode of a new series under the Concierge CPA I'm calling the Tax Strategy Hot Seat, where we cut the BS from real tax law and try to find the sparkles and unicorn poop of taxes. Do you know how long I've been trying to put unicorns and poop into all the things I talk about? It's going to be great. So this series is for not only tax advisors, but taxpayers. We're pulling everyone together to talk about one strategy on the hot seat with a very, very simple strategy called the Roth IRA, because it's coming up due on April 15th. Now, a lot of people would say, especially advisors, why are we talking about this? Everyone knows everything you need to know about Roth. But when I went and searched my advisor Facebook group called Accounting Firm Influencers, there were pages upon pages of questions that not only the advisors had, but that they get from taxpayers. We're going to actually dispel the hype, the TikTok advice, the viral YouTube stuff. We're going to get into the weeds, and I want comments as we go. I want you as my listener or watcher to actually be rating the strategy with us. We'll try to keep it to like under 30 minutes, but no promises in this pilot episode, especially because I have Jason Acriman from WealthRabbit. He's CEO over there, and he is a Roth IRA expert and all the other types of IRA junk that we're going to talk about today. And we're going to probably go long, but that's okay. So welcome, Jason. So glad to have you.
Oh, glad to be here.
We're going to be a lot of fun. Yeah, you're like the perfect pilot episode guest. And I kind of threw this on him like 5 minutes ago, y'all. So
she literally said a lot of words. I have no idea what she said, but we're going to roll with it. Let's go.
Okay. So Jason and I met last year, AICP Engage. He invited me to this beautiful dinner, like the best steakhouse in Vegas. And
Bizarre
I'm
meats.
in Dallas, Texas, y'all. So I have the best steakhouses. Jason, what was the name of that one? And I will affirm it is like one of the best, right?
Yep, Bizarre Meats. It was in the Sahara when you were there. They've now moved to the Venetian, which is a lot nicer. We never have to go back to the Sahara. It was kind of a journey, though. It's like an adventure out there, which is fun. But yeah, it's the Jose Andres restaurant. Their meats, it's like half Japanese Wagyu and half American. And then the way they cook it, it's complicated, but it's very good.
Got my 5-star rating. Okay, y'all. So we'll rate restaurants and tax strategies. Why not, right? Jason and I met there, and then he was telling me about all these cool things that he's doing at WealthRabbit, not only for taxpayers, but really for tax advisors to better equip their clients. And so, full disclosure, they are a sponsor of Taxman IQ for our advisors and users, but that's not going to influence my rating today. So be straight, Jason, okay?
I like
you
it.
Ready?
But, hey, no bull crap, as you said.
We are recording this mid-January 2026. The reason matters right now because it's the season where Roth questions come up during tax prep, and you need to be looking and asking about things during tax prep because there is a real deadline, 4/15, that's attached to it. Now, reminder for all human beings. IRA contributions for tax years generally need to be made by the due date of the return, not including extensions, which for most people is 4/15. I want you to drop a comment right now. Are you a taxpayer, advisor, or both? And for this pilot episode, I want your first official rating prediction. Is a Roth going to be a unicorn emoji or a poop emoji? Jason, let's start. What is biggest thing people get wrong about Roth IRAs every single tax season?
I think the biggest mistake is when you contribute to a Roth and you couldn't do it. You made too much money or you didn't make any money. You have to have earned income. I always tell people to wait until the tax return is done. So wait till you're doing it in the spring now to make sure you can do a Roth. You don't want to do it before and then you have to reverse it because then that is a pain in the butt.
All right. So we're going to walk through the hot seat acronym, and I will pop up the words on the screen so that everyone can follow along with what the heck we're doing. H for hot seat is hype, truth versus trends. So let's talk tax talk, finfluencers, clickbait, retirement infodemic. People repeat like gospel, and we're rating them right now. So myth number 1, backdoor Roth is easy. Just contribute and convert. No forms, done. Is that BS or is that good stuff, Jason?
That's BS. You definitely get a form, so that's definitely not right. So at WealthRabbit, we're actually creating an automated backdoor Roth because so many people screw it up when they do it.
Yeah.
So I can't tell you how many clients. So in addition to WealthRabbit, I have a CPA firm that I deal with clients all the time. I cannot tell you how many times they screw up a backdoor Roth.
I'm excited because WealthRabbit's coming out with this automated thing, right? And so when will that get released? When can people inquire about it?
Mid-February.
Love it. Okay. Myth number 2. The 5-year rule means your Roth is locked up for 5 years, period. Is that BS or true?
I guess it's BS because you can always access the money, but there could be penalties taken out.
So like there's multiple 5-year rules depending on whether you're talking about contributions, conversions, or earnings. So any video that like blatantly says 5-year rule, that's like brain rot, right?
Brain rot.
Yeah, brain rot. Okay. Myth number 3. Roth money is always tax-free whenever you want it.
Bullshit, because you have to meet the 5-year requirement, and there's some other things. But in generally, that is correct. Like that's the idea of a Roth is it grows tax-free and you take the money out as tax-free, assuming you meet the 5-year rule plus you have to be 59 and a half to take it out.
So yeah, so mostly true for contributions, definitely missing context for earnings and conversion dollars. And that's where people can kind of accidentally light money on fire, right?
Yeah.
And I'm going to toss in a spicy one that gets people real riled up. Pay your kids and fund a Roth. Now, that can be super legit. It's actually a triple whammy tax strategy because your business deducts it. Your kids can make up to 15 point something K standard deduction each year without even filing a return. And then you can turn around because they have W-2 income and fund the Roth. But it has to be real earned income and the documentation needs to be clean. So don't do like unicorn crazy math and calendaring here, right?
Yeah, that's 100% true. And that's great strategy. We do that all the time. There's not too many triple whammies in tax. That's a triple whammy.
So like HSA is another one that's triple because you get a deduction, tax-free growth, tax-free distribution. It's just like beautiful. Mwah, beautiful. For any listeners, comment 1, 2, or 3 for the myth that you see the most. Advisors, tell me what myths you're tired of hearing from clients and we might feature you. Which of those myths, Jason, do you think is the most expensive mess that can cause? Give us that in like very quick elevator pitch.
I think messing up the backdoor Roth is probably the one that can hurt the most because I can't really fix that. If you take out, there's a 60-day rollover rule. If you take the money out of a Roth, you could most likely fix that potentially. Paying your kids is a very low tax audit risk on that and a very good strategy. But messing up the backdoor and how you mess it up is you do withholding on it. You don't code it right. It was actually a taxable event. So there's a lot of ways you can mess it up.
Now we're moving on to our an overview. So this is receipts time. We're going to explain what a Roth IRA actually is, like a human being, maybe like a 5th grader or 12th grader. I'm not sure exactly what level we want to explain it at, but audience, you tell us. Let's start with quick overview. So to me, a Roth IRA is a retirement account where you contribute after tax dollars now. So you've earned the money, you paid tax on it, and then you're contributing it to the Roth. If you follow the rules, then it grows tax-free and qualified withdrawals later are tax-free. The benefit is if you're in a low tax bracket now, but expect to be in a really high tax bracket later, that leverage is kind of like where you can get a lot of benefit from, but also you get growth in the Roth, right? Jason, would you correct or change or add anything to that simple definition?
The only thing I'd add is there's no RMDs in a Roth. So you don't have to take distributions when you turn 73 or whatever, it's going to be 75 now. So that's also a big benefit.
The trade-off here is simple. You give up a tax break today to potentially get tax-free growth and tax-free qualified withdrawals later. There are 3 common Roth paths. One is a direct Roth IRA contribution if you're under certain income limits, which we can talk about that. I don't know, Jason, if you remember those off the top of your head, but I've got them later in my notes.
It's like 150 single and 250. It's around there.
So that's number 1, direct Roth IRA contribution. Number 2 is a backdoor Roth. It's not really a product, although it sounds like WealthRabbit is coming up with a way to automate it, which is awesome. So you make a non-deductible traditional IRA contribution and convert it to a Roth, and you have to file the right reporting.
In order for this to be tax-free, you can't have any money in an IRA, in a traditional IRA. So you can't have a balance. If you have like a $100,000 IRA and you try to do this, this is going to be a taxable event, or a lot of it will be. So the key is to not have any money in a traditional IRA before you do this. It's the 1231 balance. So if you're doing it for 2023 5. You want it for the 12/31/2025 balance. And a way to get around that, if you do have an IRA, is to roll that into a 401k. If you roll into a 401k, but you don't have an IRA balance, then you can do the backdoor Roth. Basically, the backdoor Roth is if you make too much money to do a Roth, this is a way to get money in the Roth, but you have to make sure you don't have that IRA balance. Unless you want it to be taxable, it might not be a bad idea to do a taxable conversion. But
so it's complicated. You need an advisor, right? It's not super straightforward. Probably don't want to decide that on your own kind of deal, right?
I always say get an advisor. We always tell people, like, make sure you consult with the tax advisor or the financial advisor, or make sure you understand it before you do it.
The third kind of most common Roth path is a mega backdoor Roth, which depends on your employer's plan features. It's not really like a TikTok hack thing.
The 401k has to allow this. Great thing, especially for your high W-2 earners. They're maxing out their 401k. But they can also do this extras, normally around $35,000 into a Roth. I don't really like when people say it's after tax and you've already paid tax on it. Like, that is technically true. But I think you're better off thinking about it as savings in a brokerage account. You're paying tax on that. If you put that same money in a Roth, it grows tax-free. You never have to pay tax on that. So it's shifting money from your savings from a taxable account to a non-taxable account, especially on those mega backdoors. You take $35K that you would have in a brokerage account in a savings, you're never going to have to pay tax on that. If you look at the super rich people, these people have millions and millions and millions of dollars in their Roths because they plan for it. And they put early on, like, part of their business stuff or stuff they're investing in a Roth, and it grows tax free. If super rich people are doing it, I kind of like to think like that's what I should be doing. When you look at the richest people, these are strategies that they're employing.
How do we make it accessible for the rest of us?
Yeah, right? Like the TikTok influencer who has no money, I'd rather go with the Peter Thiels who have billions of dollars.
So the maximum contribution for 2026 IRAs is what, 7,500?
Correct.
Okay. And if you are 50 or older, I know that got more lenient in the recent years. There's a catch-up amount of 1,100. Is that right?
That didn't get lenient. That's always been like that for a long time. If you're 50, which means you turn 50 on the last day of the year. So if you're 49 right now and you turn 50 on December 31st, you can do the extra 1,000 for 2026.
And then we've got our income phase out. So Jason just mentioned them. You can Google it anytime. Make sure that you're using the right year, of course, or just look on your prior year 1040 and figure out that it's based on the AGI specific line, right?
Yep.
Yeah. So you can find the AGI line on your 1040 and see if you're over, under, or close to that, like 153,000 to 168,000 for singles. So it's like a phase out range, right? To where you go from, you can do 7,500 to less or nothing. And then marrying, filing joint is 242,000 to 252,000. Okay, cool.
That's why we said earlier, just wait till you're doing the tax return because you have till April 15th to do for the previous year. Just wait till you're doing it so you know you can do it.
We talked about kind of what some of the hype is. Is there anything else that you can think of, Jason, at this point that clients really misunderstand most, whether eligibility, 5-year rules, or backdoor mechanics?
I think we've basically hit it, but it's kind of a weird strategy because it's not a tax savings now. You're saving for taxes later. So It's really, like you said, the low income people. I just think in general, if you're young, you should be doing Roth 401k, everything, because your time value, money, and growth, no matter what tax bracket you're in. That's my personal opinion. I do 100% Roth 401k. I do backdoor Roths. Like, I want everything in a Roth and growing tax free because I feel like I'm not going to take this money in 30 years. I'm going to have a lot of growth in there that's going to grow tax free, and then I don't have to pay tax when I take it out. I want that deduction right now to save money now. And sometimes we want to do that, especially in the highest tax bracket, year sale, blah, blah, which things we want to do. But I like the idea of having a money in an account that's growing tax free that I never had to pay tax on.
So bottom line, Roths can be amazing, but they're not like automatically amazing. We're going to stop people from applying this wrong because the fastest way to turn unicorn, rainbow beautifulness into shit is misusing the rules. So that gets us into our T in the hot seat, target fit. Who is it for? Who is it not? So let's talk through like a yes profile first, Jason. Your income qualifies for a direct contribution and you're playing the long game, right? I mean, that's an obvious given.
Basically, if you aren't through that phase out, you're in a low tax bracket, you should be doing a Roth. So the only time I wouldn't say that if you're in phase outs like American Opportunity Tax Credit or something where like every dollar you can save is going to save you more than your tax bracket, then traditional might be a good option. But I would say in those brackets, without knowing everything, a Roth is a good idea.
We've mentioned this before, but you're earlier mid-career, you expect income to rise and you want that tax diversification later. Another yes is you can cash flow the contribution without needing a deduction to survive. Obviously, like cash flow is important. If you have no money, you may not want to, put it all in one basket with the Roth.
And I will say one nice thing about the Roth, you meet that 5-year period, you can take the contributions out tax-free, and those always come out first. So you do have more access to a Roth than you would a traditional. You always pay tax when you take the money out. So that does give you a little freedom in the savings. You obviously don't want to do that because then you're losing. The whole point of a Roth is you want that long-term growth, but you do have more access than you would in a traditional setting.
So for target fit, a no-go or not now would be someone that really needs a deduction today, maybe for cash flow, and the Roth contribution would squeeze them real tight. Number 2 could be you're trying to do a backdoor Roth, but you have significant traditional SEP or simple IRA balances and no plan to address the pro rata impact. We were talking about that kind of before recording, right, Jason?
Yeah, and that's what we're talking about. If you have a balance in an IRA, it'll be taxable if you do the backdoor.
A third no-go, you need this money short term. You're using Roth like a checking account. It doesn't function like that. What is the penalty if you take before the 5 years out?
10%.
Plus ordinary tax, right?
Yeah.
It adds up. Okay, taxpayer maybe profiles. 1, you're near the income phase out and you need to manage your adjusted gross income or AGI to qualify for a Roth. 2, you're considering Roth conversions in a year where income is temporarily low. That's where planning can really matter. Advisor yes clients. 1, eligible for direct Roth and needs a simple funding plan during tax prep. That's always a great strategy to recommend. Another thing advisors love, you've got high income earners who want backdoor Roth and can do it very cleanly. Another clients who need tax diversification and long-term planning. Advisor no clients would be they refuse documentation, they want TikTok speed, they don't want tax law, they have messy basis history, missing prior 8606 tax form filings and won't clean it up. Another might be they want guaranteed outcomes, like, are you going to guarantee me that I'll get a 10% market rate on this? It's a strategy. It's not a crystal ball. Jason, any other yeses or big hard no's?
The only person that can guarantee 10% is Bernie Madoff. So what you said is exactly right. And I think for our clients, most high net worth earners, they have a 401k and you can move money in the 401k so you can do a backdoor Roth. I don't know what percentage of our clients do backdoor Roths, but it's a lot. And I think the other strategy is pay the kids if you have your own business, especially if you're Schedule C, because if you're Schedule C, you don't have to pay FICA tax on your kids. So it's like, that's a quad. That might be a quad savings because you get tax deduction.
I gotta explain that real fast. So if you file as a sole proprietor, Schedule C, doesn't matter if you're LLC, not LLC, or a partnership where the parents are the only partners, there's this exception in the tax code that allows you to pay kids under age 18 and not pay any FICA tax. It's amazing. So that's another...
A W-2. You basically just have to do a W-2 at the end of the year. So you don't have to pay unemployment tax on them. Most, I should say, I don't know all the states, but most states, you don't have to pay unemployment tax on them. No withholding. So you just do the W-2s at the end of the year. And that's the quad. So like pay the kids $15,000, like you said, the standard deduction. You have to make sure the kids don't have any other earned income. So you don't want to have to file a tax return for them.
I had a client once that they didn't tell me that their kid had like interest and dividend income that added up like to $3,000. And so we were able to reasonably pay the kid right at that standard deduction amount. And then we got that form later and it pushed them over where they had to file and pay tax. And I was like, oh, this ruined my whole thing.
I always ask before I do that W-2 at the end of the year, because normally they're paying the kids throughout the year and it could be on payroll. It might not be on payroll, but a lot of times you just do it at the end of the year. I always ask them, like, did the kid have any money? Normally they're working at like Chick-fil-A and they made $3,000 or something like that. That's why I normally don't pay them up to the 15. I normally leave like a couple $1,000s just to be safe. Obviously, you want to get them close to that standard deduction. If you pay them 12 or whatever, the key is to pay them enough to do the Roth. You have to pay them $7,500 to do the Roth. Sometimes we'll just do that, but it depends on the parents' cash flow and stuff. But I like leaving a little room there. just to be safe.
Yeah, I'd agree with that. So that is the hot of our hot seat. Now we're going to get into stumble points. Where do people screw this up? Okay. This is where good strategies go to die. Mistake number one, they do a backdoor Roth and don't file Form 8606 correctly. And then later get confused why a 1099-R looks taxable. The form ties it out. You have to reconcile.
I see this as a mistake that I catch other CPA firms doing all the time. I see a $7,000, $7,500 taxable IRA. I know that's a backdoor Roth that they didn't put right on the tax return. So if you did a backdoor Roth and you know it shouldn't be taxable, if it shows up as taxable on the tax return, you did it wrong. And people ask me like, when should I not do my own tax return? And I think like if you're doing these type of strategies, you need to have someone do your tax return. Like, it's not worth it. You don't know. Sure. We do hundreds of these all the time. Like, you're doing one tax return a year. Like, your time is spent other places. Let us make sure this is done right. $7,500, if you make that taxable on the tax return, that's like $2,000 or $3,000 of tax. Yeah. I see that mistake all the time. That's like low-hanging fruit when I'm viewing tax returns from other preparers or themselves. Like, I can tell that immediately. You didn't do that right.
Yeah, I mean, in Tax One IQ, which is, a tax advisory for advisors, right? Accountants, not for taxpayers directly, we'll scan the 1040 and we kind of red flags as well to then like suggest that something was a mistake. So I know that one does pop up quite a bit.
Probably one of the biggest mistakes I see.
Yeah, for sure. The other like huge one that I see, which I won't get on a tangent, but is QBI.
QBI, net investment income. They sell a business and they subject it to net investment income. That happens.
I see people hundreds of thousands of dollars.
Yeah, that's a great one if you catch it, because that is saving lots and lots of money. Like Roth IRA, a couple $1,000s. Net investment income could be hundreds of thousands of dollars, like you said. And then you look like the hero.
That's going to be, I'll do like an emoji of a rainbow. That's getting us off track. We're going to pull it back on track to Roth IRA. There's so much to talk about here. Other mistake. They mix up tax year contributions with calendar year conversions. Those are different timelines, right?
So conversion means you're moving from a traditional to a Roth. That's taxable at the time you do that. So if you're doing that now, let's say in January, and you think it's for 25, that's actually for 26. And there's actually, to go on a slight tangent here, but there's a new concept for SEP IRAs. This will be very big for SEP IRAs, which is a Roth SEP. But the timing is a little weird because when you do consider it a traditional contribution that's converted directly over to a Roth, but you're doing it for a previous year. So that could be a tax timing where, like, let's say in 2025, I was in the 37% bracket, but I'm going to drop way down in 2026 to the 12%. If I do a SEP Roth, I would get the deduction in 25 and pay tax for it in 26. That is a planning strategy that we are implementing for people.
Oh, cool. Okay, yeah. And then SEPs also aren't due until the extended return deadline versus Roths for 415.
Yeah.
So I'm sure.
Yeah, the IRAs are the only 415 ones and the HSA, but all the other retirement plans are normally with extension.
All right. Any other stumbling points where people screw things up that I did not mention that you're like, we have to make sure and say this?
The biggest thing with clients is you tell them to do a Roth and then they do it like at a bank and it just sits in cash. The idea of a Roth is you're growing tax free. They put it in there and it sits in cash and it's never growing, you're not getting the benefit.
One thing that came up on Reddit from taxpayers, they were like, wait a minute, I put the money in the Roth and then I have to invest it?
Yeah, and that's where like we manage all the assets and we pick the portfolios, like we actively manage it. So you're not picking stocks, you're just telling us your risk tolerance and we invest it for you and we made sure that it's not sitting in cash. You don't want to set up an IRA at a bank. You want to set up an IRA at a financial institution where you can invest the money in the market.
Yeah.
I'm in tune with the Reddit people, with the Redditors.
Let's move on to economics. So I want to look at just simple math, right? Is the mathin', simple ROI here. So what I like to do to overly simplify it, but understandable, is literally just take whatever the contribution is each year and then multiply that by standard kind of market or stock growth rate that it can grow by, because that's going to be tax free. Now, Jason and I were talking about this, and obviously there's present value calculations. There's a lot more to it. And the market rate I tend to use is ultra conservative, like 5%. Jason, what would you use as more realistic for 2026?
The market on average goes up between 9 and 11%. Like last year, the S&P 500 was up 17%, I think. But that's 1 year. So on average, it's 9 to 11. You're not going to be 100% in stocks. So I think a better range is the 7 to 8% for a conservative number.
But let's use 7,500, the max 2026
Oh, I hear a
contribution.
calculator.
Yeah, I am the loudest typer in the world, by the way. I'm
Yeah.
also one of the fastest typers. So
Yeah, I heard you typing before, and I was going to say that's incredible work. So, as a fellow CPA, like, where's your green visor?
Oh, I know, right? I have a green Grinch. I have a fake it till you make it first.
Maybe we'll do some WealthRabbit green visors for accountants and send them out.
Ooh, that would be so fun. I've got little dancing cats. I've got all kinds of fun stuff here. I don't have the green visor. Dang it. Yes, Jason, send us the visor.
Okay.
Comment if you want a visor. Okay.
Yeah. Comment. I'll send everyone visors. I don't know how, but we'll figure it out.
I'll make it work. I'll hook it up. Okay. So let's do the ROI math. We've got 7,500. We're contributing. We're going to multiply that. I'm going to use my 5% because I always like to be ultra conservative. It's $375 a year. And so how you would show that to a taxpayer is you would literally say, okay, year to year, it's $375 in savings. You put in whatever cost goes alongside that, right? So are there third-party fees? How does that work, Jason?
Most custodians, like our custodian charges $10 a year to have a IRA. That's a typical fee for that. And then you're going to pay like 50 basis points, which is 0.5% to manage the fees. You're going to pay the advisor fee. And then there's going to be fees in the funds. And like an ETF, those are around 10 basis points, which is 0.1% to 0.2%. That's good. That's what you want to be in. Like a mutual fund will be in 1.5%, 2%. You want to be in good stuff because you want to minimize those fees. So all in, like with WealthRabbit, you're paying 65 basis points, including the funds, which that's good. Like if last year's return was 17% minus our fee of 0.65, you made 16.35%. And I would always encourage people, there are a lot of hidden fees, especially in advisors. If you are with an advisor, ask them like what the underlying costs are and why are you in mutual funds? And we're big ETF believers here. We have our own wealth side and we almost have all portfolios or ETFs because they're more tax efficient too. Mutual funds throw off dividends at the end of the year, where ETFs normally don't.
That actually makes the 5% perfect because then we don't have to worry about adding like third-party fees and stuff at the bottom. Because if you're netting it all together at the top, then you're good, right?
Yeah. Like 5% would be a very conservative portfolio, like mostly bonds. Like, and for like, some people want that based on risk tolerance. Like 5% is better than sitting in cash.
So if you are watching or listening and you want to see my like ROI cheat sheet on how the savings comes together, comment math and I will get over to you. Ooh, this is the fun part. Okay. Well, fun for me. So assess, we're going to actually rate the strategy using my ROI method of value pricing curve assessment. Okay. So what is that? Well, curve is rating the complexity of a strategy, urgency of a strategy, risks of a strategy, and the benefits, including whether it's a one-time benefit or long-term permanent tax savings, which this would be, right?
We're getting a good score. I can already tell. I just have a feeling. Okay.
So I'm going to go through each one and give my score, and then you have to give your score, and you need to write it down, Jason, because I'm not going to remember your score, okay? And get your visor.
Oh, God, if I had one. Hey, you know what? I got trucker hats. So
very nice.
A nice Jewish boy with a trucker hat. How about that?
I like it. Okay.
All right, I'm ready. I got my pen.
Awesome. C is for complexity. So I'm going to go 1 to 5 score, 1 being the lowest complexity and 5 being the highest. I'm not giving this a 1 because there are a lot of nuances, but I'm going to give it a 2. Okay. Jason, you give us your real number.
I agree with that. I think in general, like in the scheme of tax planning things, like this is a relatively low complex thing. So I agree with that.
Beautiful. U is for urgency. We're coming up on April 15th. It's like live or die based on April 15th. I mean, you can't go back, right? Like it's over.
Correct. But one thing I like about it is you don't have to do it by the end of the year. If you're trying to get it done before the end of the year, that's hard. So it's nice to have the April 15th for this.
2 or 3. I'm going to give it a 2 because it's on the lower of urgency. What are you going to give it?
I agree with that. Let's go with 2.
Okay.
We're lockstep.
Next is R, risk. Okay. Direct Roth contribution is pretty low, maybe like a 2. If we complicate it with like backdoor or things like that, that obviously goes up.
To me, like, this is a are you going to get audited or a 1? Like there's some tax strategies, like you do conservation easements, you do stuff like that's a 5.
Yeah.
Like a Roth is conservative. There's nothing crazy. You don't need lawyers to write opinions on this. We know the rules.
Sure. I'm going to go with a 2. I don't know if it's really more complexity I'm thinking or risk, but I feel like when people do screw this up, like you may not got audited, but you may be way overpaying in your taxes, right? And I hate that risk. I'm going to go with a 2. Okay.
Okay.
And I don't want the exact same score of you, Jason. Okay. B in curb is benefits. So there's 2 factors here. General, what kind of benefit are you bringing to the table, like financially, right? This isn't a huge number that we're pulling every year, right? So that's probably lower. But the other aspect here is this is permanent tax savings, or is this like depreciation expense, which is a deferral, because that really changes like the benefits that you get. So are you going to give it a high benefit score closer to 5, or are you going to give it
I'm going to give it a 4 because the only thing is you can only do up to 8,500 if you're over 50. So there's a lot of things, like you pay your kids. You could get more benefit than that. So I can't give it a 5 because 5, I think you got to save $10,000 plus dollars. I'm going to give it a 4.
I'm debating a 3 or a 4 because I think everyone needs to consider this in their like portfolio. And so I would want to rate it higher, but then it's like the financial benefit isn't necessary. I mean, but it does add up. Like what's that saying where we never talked about that math, Jason? Like you put in 5,000 a year over 20 years and you end up with what? Like over $1 million?
Yeah, like these new Trump accounts are coming out to segue this, but like that's the idea is like, hey, we give these kids that are newborn $1,000. That's going to grow. They say if you look on the Blot Trump account website, it's like $31,000 when they're 18. What I like about IRA too is like you kind of look at it as I can't touch it, and it's just you forget about it and you put it there, and then in 5 years you look and you're like, oh, I doubled my money, or like normally it's 7 years you double, but you can get a lot of money in these Roth IRAs. Depreciation, that's a one-time thing that you're going to get something later, but like this is you're doing every year. You don't have to worry about employees. You don't have to worry about anything. It's just like.
All right. So this will be interesting because I use Curb to typically like price how, as an advisor, I would help the taxpayer, right? But Curb is weird to use with this because we're talking about $375 a year times, let's do our average. So I'm going to go with 4 on B as well. So my average, I had 3 2s and 1 4. So I got a 2.5. What's your average?
Oh God, 9 divided by 4?
2.25. Okay.
I don't need a calculator for this.
Look at you. Yeah, you're mathing over there. I love it. Here's the question at hand. I'm going to open this up to the public because I thought I had this all figured out. Is the unicorn the lower score or the higher score? It's confusing because complexity.
You almost need to reverse some of these things because like risk should be like the opposite. Complexity should be, so we got some work to do. We got some work to do on this scale.
So you do your switch. I'm changing my 2s to 4s and my 4 to a 2. And that's going to give me a true unicorn average. So
15 divided by 4.
3.75. That's closer to unicorn status. Okay, I like it.
I'd say like a Shetland pony of unicorns, like a baby unicorn. You know, we're not the big guy. We're not like, hey, Charlie. This is like an early internet joke. Everyone Google Charlie Candy Mountain and you'll know what I'm talking about.
Like after the episode, don't steer away.
No. Not now. Not now.
Okay.
Later.
All right. Drum roll result. The closer we are to a 5 is like ultimate unicorn rainbow gold status. The closer we are down to a 0 or 1 is shit emoji. So Jason had 3.75, which is very nice on the unicorn scale. And I had 3.5, which is a little bit lower. So I'll have to figure out different emojis for the ultimate unicorn versus the mid unicorn. I love it. Okay.
Ours is like, a little older. He's got a limp on him. Maybe his horn isn't 100% right, but he's still a unicorn. Oh, he is.
Yes. Okay. So everyone watching or listening, drop your curb score or forget about curb because it was way too complicated. I'll make it better, I promise. And give it just a unicorn or poop emoji today. I can't wait to see your results. Okay. So on that note, I have no idea how long that took, but that's the basis of our episode. I'm going to put Jason in the hot seat at the end here. So before we do some additional bonus content, hot seat material, I do want to close out for anyone that does need to go with a couple takeaways in CTAs. Okay. So takeaways for the taxpayers. If you qualify for direct Roth contributions, this can be a really clean long-term move, and tax prep season is the time to ask. That's tip number one. Number two takeaway. Don't let the internet convince you backdoor Roth is a casual click. It's a process with reporting. Number three, ask about this before April 15th so you don't miss your funding window for the prior year.
To open up an account and like to fund it, it's going to take more than one day. So you can't do it on April 15th. You got to wait a few days before that. You can do it on the 15th, but to logistically set stuff up, you got to take a few days.
I love it. Okay. 3 takeaways for advisors. 1, ask about existing traditional SEP and simple IRA balances early. 2, train your team on how Form 8606 ties into 1099-R reporting. It's all about being a detective with this stuff, y'all. You got to look at the forms, look at the work papers, and be like, ask a question. That's everything about tax planning and strategy, and that's what makes our job so amazing. Number 3, if your client learned this from Tax Talk, slow it down and document it. Okay. Any other takeaways for advisors, Jason?
I think we've hit the nail.
Okay, cool.
We're good.
All right. So what are our directives from here? Taxpayers, if you want help, we actually have a full certified concierge tax plan IQ advisor directory now. We are mass releasing it any day now. So find a qualified tax advisor through that directory or go talk to your tax advisor today about the things that we discussed so that you don't miss out. And I will try to put the link to that directory as soon as it's available in the chat, but hype me up, tell me that you want it, and I'll get it out there faster, I promise. Now, advisors, join our Tax Plan IQ community, request a demo, get the resources that are in our entire strategy library. Jason did an entire, what we call strategy hour with our team where he deep dived into this. Everything an advisor would want to know. That was back in October. That's all in our resources within Tax Plan IQ. Of course, if you want help implementing the strategy, go to Jason, go to the WealthRabbit team. What is the easiest way to get a hold of y'all, Jason?
Support at wealthrabbit.com. Call our phone number. I don't remember it off the top of our head. The whole idea of WealthRabbit is to make it so that you can set up the accounts easily. The CPA can set up for the clients. So like be the you've recommended the strategy. Now make sure the strategy gets done. That's the idea.
All right. So everyone, post your ratings, drop your questions. I actually may try to like fill in the gaps of additional Q&A that you have after the time together live. So that'll be a lot of fun. Also, tell me your favorite like BS alert miss that you see online. We can fact check it and request other strategies that you want to see on the hot seat. All right. So on that note, let's do our hot seat quick hits. Okay. No spiraling here, Jason. I'm going to start with 3 questions. I want like 20 to 30 seconds each. Really straight answer. You got it?
Yep.
Okay. All right. If AGI is under the threshold for a direct Roth contribution, what else do you recommend looking at during tax prep?
If they're under that, then there's probably a lot of credits they can get. I'd look at the Roth conversion, American Opportunity Tax Credit, the plug-in vehicle credit is gone now, but stuff like that phases out early, you're probably close to the threshold where you could get that. And then I would look at the conversion. If they're at a low tax bracket, that would be in the 12 or 24%, 12, 22, 24. Like that's a good planning opportunity for a couple of years doing
All right. I'm going to go pull this question that I had in the accounting firm influencer group from Facebook because I want more like hot topic questions from online.
I want like TikTok questions.
Yeah. Oh, this is a great one. Okay. Worst advice ever without any context when you've got your YouTube influencer or TikTok advisor that's like, you can invest in your own real estate through the Roth. Why is that real bad?
So a couple reasons. One, you don't get to take the tax advantages of depreciation. So you're a big part of real estate is you want the upfront depreciation. You don't get that. Second thing is you have to do a fair market value in an IRA every year. And in order to do that, like you're supposed to do an appraisal every year. Most people, like you're not in compliance with that if you have businesses or these type of assets in an IRA. Also, like if you're actively managing the property, you can be subject to unrelated business taxable income. There you go.
Yep.
And you have to pay tax on the earnings in a Roth IRA, which you don't want to do. Normally recommend, plus you don't get a step up in basis when someone dies. I mean, it's in a Roth, so you don't really need that, but it's not the vehicle for that.
Yeah. There's a lot of caveats. Like, it sounds really cool, but and even when I think you might have mentioned this, but just in case to reiterate, I see people thinking that they can put personal residences in there, and that actually disqualifies it from tax-free growth completely. That's where like the UBTI comes into play and stuff like that. And
Yeah.
so
The worst thing to do is put your personal residence.
really unrelated party investments are potentially okay through what's called like self-directed IRAs. There
Yeah.
are times and places for that, but you need a tax advisor in the middle of that situation, or else it's going to get real messed up, right?
Yeah. Well, I'll tell you, for me, I do PE investments in my Roth IRA. I do want, like, to me, I want the riskier stuff in there because if it grows a lot, that's a lot of money I could make. So I personally do PE investments.
So different brokers are not going to necessarily allow you to do alternative investments like that, right?
And I would say, like, if you've got a lot of money and you don't have a broker if your financial advisor is not offering these alternative investments like private equity, private debt, you need to be thinking of a new advisor because that's the whole point of having an advisor with stuff like that is like you want to get into these things.
Now, this was news to me. So this was a question directly in my Accounting from Influencer Facebook group for accountants. There was some change in the law, I guess. Some kind of stipends allow you to qualify towards contributing to a Roth IRA. This is really like crazy off the cusp.
You're working at a school and you're getting a stipend to teach there or whatever.
Yes, not stipend. Sorry, my bad. So yeah, so you don't necessarily get a W-2 because a lot of people will say, oh, you have to have a W-2 to contribute to Roth, but there's something special about that scenario, I think.
Yeah, there are special rules with that. And there's scholarships, sometimes they're taxable, sometimes they're not, sometimes they're earned income. So I would say that is true, but I gotta look up the individual rules.
Okay.
That happens like once or twice a year, and then I got to figure it out. Let me tell you one other strategy too that we didn't really talk about. That's a little nuanced. A sole proprietor, and they want to do a retirement plan. Let's say they make $50,000, and you've recommended them to do something in a retirement plan, and they don't know exactly, but they say they want to do $5,000. You could do a traditional. Like, which one would you choose? And if you can do an IRA, it's better to do an IRA than a SEP because a SEP is going to reduce QBI, whereas an IRA will not reduce QBI. So I'll catch that every once in a while. Like I'll see somebody and they'll do a $4,000 SEP. I'll be like, don't do that. That's a little nuanced thing to look at. It'll save a little money if you do an IRA versus a SEP IRA. Just thought about that now when you were talking.
Yeah. No, that's good. That's why we're doing the kind of extended off cuff version here. We can throw in extras.
This is after hours.
Where's the drinks?
I'm not going to tell you what's in here. Not sponsored, could be.
All right. I mean, I think we pretty much hit it. So I'd say if you're still listening or watching and you've got more for us, put it in the comments.
Yeah, I said support at WealthRabbit. If you want to, Jason at WealthRabbit, directly to me, I'll answer your questions too. If you have any, not just on Roth IRAs, but any retirement questions, happy to answer them.
Well, on that note, we have determined that the Roth IRA as a tax strategy on our hot seat series is a limping unicorn. Thank you, Jason.
It's not a poop emoji.
Yes, it is not a poop emoji. I love it. Oh, I also have a poop pin.
Oh, we don't need to get that out of here. Oh, you just thought it was going to be shit. You didn't even bring the unicorn. Unbelievable.
Well, I promise.
We have the math. We have the math to prove it.
We have the receipts right here. Okay. All right, y'all. Had a great one. This was so much fun. If you enjoyed this episode, please let us know and we'll keep running with the series. If you didn't, be kind. Let me know how to improve it.
It can only get better.
Take care. Blessings to all. Bye for now.